The 2008 financial crisis was the worst financial crisis since the Great Depression of the 1930s, and we can still feel its effects to this day, from austerity to political turmoil such as Trump's election and Brexit. Around the world, banks collapsed, governments fell and rose, stock markets crashed and burned, and entire countries plunged into debt. The world financial system was about to disintegrate. The ruination of Earth was thankfully avoided, or postponed depending on your disposition, with the combination of government bailouts, cooperation between banks, and the recuperative power of capitalism. Whilst this was a global crisis, its beginnings were entwined with a bank which was simultaneously the biggest bank in the world, yet also a proudly Scottish institution that strove to show itself as a bank for the everyman. In this documentary, I'll investigate the role RBS had in the crisis and how a bank with a distinctly Scottish image and history found itself in the eye of the storm. Founded in 1727 in Edinburgh, RBS was a concoction of Scottish brands such as Child & Co, the oldest brand still trading in British banking with it being founded in the 1640s, as well as Coutts and Drummond's. In the 18th century, Scotland formed a unique, multi-bank system that proved to be far more stable than the rest of Britain. Indeed, in the middle 1800s, the British government altered English and Welsh law to mimic the Scottish system. It's clear then that Scotland was a pioneer in the banking profession, with RBS playing a vital role in its innovation. How did it all start to go wrong? The foundations of the ensuing disaster can be traced back to 2003, where strong flow of funds was coming from developing countries, and as a result, risky assets were receiving increased funds which drove down credit, which made high-risk investment considerably cheaper. As it was now cheaper, the amount of risk-taking increased dramatically, specifically in the housing market, and this led to the growth of subprime loans, which is a type of loan that is offered at a rate above prime, the lowest rate of interest at which money can be borrowed commercially, to people who couldn't qualify for prime rates. This meant that people were taking out loans which they couldn't pay back in order to afford housing. For years up until the crisis, RBS was seen as the face and icon of Scottish business. In 2006, the bank recorded a turnover of £28 billion as well as £9.2 billion in pre-tax profits, then going on to beat Barclays to the ill-fated acquisition of the Dutch bank ABN AMRO for £49 billion in 2007. As the takeover cost the bank a substantial amount of money, so much in fact that it depleted their financial reserves just as the 2008 crisis reared its head. RBS was heavily criticised for the takeover, as there was acknowledged global uncertainty in the financial sector, but RBS, who also made a hostile takeover of NatWest in 1999 and received considerable benefits from that, had decided it was worth the risk. It wasn't. In 2008, RBS was subsequently bailed out by the UK government, and therefore the taxpayer, for a modest £500 billion. This led to RBS now having the majority of its shares owned by the government. 62.3% of shares are still government owned as of 2019, and also cost RBS CEO Fred the Shred Goodwin his job in knighthood. While all this has been covered in detail throughout the years, it fails to convey the experience of the average bank employee at the time, and I feel that their story is a vital component of the saga. In order to tell their story as accurately as possible, I felt it imperative that their testimony is given first hand. I travelled to a bank in Ayrshire where I would meet with two former employees of a major British bank. They both worked for the bank before, during and after the crisis.
My job at the bank was a private banking manager.
My job in the bank specifically was started as a customer service officer in the bank, promoted quite early to branch manager, then promoted again to area sales manager, and then up to area manager personal within the bank, covering branch banking and private banking.
It actually affected me personally. I had took out a mortgage for 5 years because I was worried that rates were going up, and then tied my mortgage in, and then about 2 weeks after I tied my mortgage in, the whole banking system collapsed. In the run-up, it kind of really felt like business as usual, and it wasn't until after it was all kind of happening, then I had actually went off in my honeymoon and came back, and when I came back it was like, well, what's happened to the world? So I was playing catch-up kind of a little bit when I came back, but I couldn't believe how much damage had actually been done, and it just kept coming and coming and coming. It just didn't feel like there was going to be an end to it.
My experience changed. I think it changed when I was sitting at a desk and my redundancy letter came on the desk. I think that's when you kind of realism, I would probably say, comes into being that you're probably there as a number now, where in the past, and as the heyday as you called it, you probably thought you were actually part of an organisation and felt part of a family, if that's a better expression for it.
In the years since, so the crisis obviously caused a lot of restructure within the bank. So from private banking, I subsequently moved to business banking just for a kind of career change as opposed to anything else. Moved then to Paisley, worked as part of the team in Paisley, then got repositioned in Kilmarnock because I lived locally, and then subsequently from there in 2016 business banking restructured and centralised in Edinburgh, and that resulted in us in Kilmarnock being made redundant or given the opportunity to find another role within the bank. So I took the first one, I took the redundancy payment, and ventured off to find a different career on my own.
The crisis, I wouldn't probably have said affected me personally, as in from a personal point of view. After 2008, the only thing that would have affected me financially was my share saves. I had quite a number of share saves, which obviously the bank I worked in at the time, the share price crashed, which I probably lost £30,000 to £40,000 of my own physical money, and that was seen right across the board from all staff members that were told to take share saves, etc. Fall safe, going forward, part of your pension at the end of the day when you retired. That was part of to take the money on.
We took because my job was a private banking manager, we did take a good bit of heat because we were dealing with a kind of higher end customer base, so they were obviously concerned about the bank going bust, had certain levels of compensation within the bank, but because we'd built up a relationship with the clients, it was an easier conversation to have, to try and reassure them that things were okay, they did have protection, that the bank were just changing little bits and pieces and things. So I think we got, although we have a smaller customer base, we got that pretty intense. But in relation to abuse and all that type of stuff, we tended to miss most of that because we obviously built that relationship and we weren't behind a pane of glass. They could come in and sit and speak to us, so it kind of worked both ways, I think.
Did they close branches because of the crisis? I would probably say no, if I'm being brutally honest. Seeing figures of the rural branches, as I probably alluded to in my the last question, was rural branches were part of the community. They're always seen as a sort of part where everybody sort of met, and they would do community things within small areas, especially small mining towns, etc. But from a business point of view, it probably should have been looked at before the crisis. Were they making money? Because at the end of the day, it is a business. People forget that it is a business at the end of the day. So were those branches making money? They weren't making money. They were there as a sort of service probably provider to that. When we actually looked at the actual numbers coming through the banks and the branches, then unfortunately people didn't use the branches as much. And again, it's the youth coming through today don't use branches. It was the older people that were using them. I would say it affected businesses more than the actual personal clients on the high street and in the small villages. But I don't think they used that as an excuse to close the branches. I think it was needing done. It cost a lot of people jobs and reputation, but I don't think it was used as a stick, shall we say.
Did they close branches to increase profits? It could easily be seen to be that, but there's also the element of technology. People do bank online. They ultimately, at the end of the day, they're running a business. So if I had a shop that no one was coming into, and I could operate that business via a cheaper alternative method and still provide a level of service, then I would probably look to do the same thing. So that's a difficult one to answer. Part of me thinks, yeah, it probably did, but then part of me thinks, well, actually, no, if it was any other business that didn't have the sustainable footfall, then I would have expected that they would have followed something similar. But because the banks are under heavy pressure and public scrutiny, then it would obviously be deemed that they were cutting costs to try and recoup.
I found that Paul and Derek's differing experiences to be quite fascinating. On the one hand, both emphasising the fact that RBS was a business and that they were entitled to make decisions that would benefit their business, such as closing branches. Their experience differed when it came to customer relations, and this was particularly interesting to me. Paul, being a private banking manager, which meant in turn he had a smaller circle of customers with a more personal relationship, didn't suffer the wrath of customers coming through the door that Derek did, as he was on the front lines in branch banking, so to speak. Curiously, both also felt that the reputation of Scotland wasn't affected by RBS and other UK bank failures, as it wasn't just our main Scottish bank that was involved, but rather a global catastrophe that involved many different countries, banks and institutions. The revelations that I've learned during my time making this short documentary have been surprising to say the least. As I set out to make this production, I had a fairly clear idea of what probably caused the crisis, mainly due to the media's coverage, and it was all down to the staggering arrogance and gluttonous nature of executives, bigwigs and CEOs that we have seen in almost every stereotypical portrayal of them from films, television, books, etc. The actual causes are, of course, far more complex than that. While it's certainly true that the leaders of the financial world undoubtedly had a fundamental role in the crisis, I find that their folly is actually a symptom of a larger societal disease, a disease of consumption and gluttony. This is in no way an anti-capitalist sentiment. To paraphrase Churchill, capitalism is the worst economic system, except for all the other ones. Indeed, even Paul and Derek had little animosity towards the bank as a whole, despite the considerable impact RBS's failings had on them. RBS's fall was catastrophic for Britain's financial health, and only through exceptional statesmanship was a deep depression avoided. However, in terms of their role in causing the actual crisis itself, it could be argued that RBS was in fact just another institution that was caught in the maelstrom caused by the hubris of American hedge funds, banks and insurance companies, and the desire to sell and make profit regardless of the consequences. It would seem then that we should treat banks and the financial sector as a whole in the same way we treat fire, with respect, due diligence and consideration that can be the most fundamental tools for prosperity. But, if handled brashly, arrogantly and insolently, it can spread and reduce our foundations into cinders.